Assalamualaikum warahmatullahi wabarakatuh. The Honorable Mr. Dr. Suherman, MSc, as the coordinator of the Bachelor Management Study Program at the Faculty of Economics, State University of Jakarta, and as the first supporting lecturer. The Honorable Ms. Destria Kurniati, SA, MSc, as the second supporting lecturer, and the examiner lecturers. My name is Nisrina Nur Fadhilah from the Bachelor Management Study Program, State University of Jakarta. Today, I would like to present my research proposal with the title, Analysis of Factors Affecting Company Value, Empirical Study on the Manufacturing Companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Here is the table of contents for today's presentation. First, I will discuss about the introduction, namely Chapter 1, which consists of the background, problem formulation, research objectives, and research novelty. In Chapter 2, we will discuss about the literature review, which consists of theoretical background, relevant research, framework, research model, and hypothesis. And then the last chapter is Chapter 3, or research methods. We will discuss about time and place of research, research approach, research variables, population and sample, and also data analysis technique. First of all is introduction. The background of this research is because generally based on stock index data listed on the IDX or Indonesia Stock Exchange, there are manufacturing companies that have a large or small average price to book value ratio, so that the average value of this ratio fluctuates every year. This makes it necessary to investigate the factors that affect it. There are two graphics here. The first one is, the first graphic is a company value growth of manufacturing companies listed on the IDX for the period 2016 to 2019. There was a fluctuation in the value of PBV ratio. From the initial value of 1.46 in 2016, the price to book value of the manufacturing industry increased in value in 2017 to 1.77. And then in 2018, the PBV declined to 1.65 and closed at 1.42 on 2019. And then in the second graphic, there are three subsectors of manufacturing sectors, which are chemical industry sector, and then goods and consumption sector, and also miscellaneous industry sector. We can see here that in the basic and chemical industry sector, the value of the company tends to increase every year. While in the goods and consumption sector, the value of the company continues to decline every year. And in the miscellaneous industry sector, the value of the company tends to fluctuate. So the company value is determined by several factors, including dividend policy, profitability, capital structure, liquidity, and company size. Research on the analysis of factors that affect firm value has previously been carried out by many previous researchers, but there are many differences between one study and another, as well as sector differences. So that is the reason why I choose this topic. These are the formulations of the problem. First of all is, do dividend policies, profitability, capital structure, liquidity, and company size have a significant effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the period 2016 to 2019? Second is, does the dividend policy have a significant effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period? Third is, 3 is, does profitability have a significant effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period? 4, does this capital structure have a significant effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period? 5, does liquidity have a significant effect on the value of manufacturing companies listed on Indonesia Stock Exchange for the 2016 to 2019 period? And then lastly, does company size have a significant effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 until 2019 period? Okay. And then the next one is research purpose. There are 6 purposes of this research. First of all, is to determine the effect of dividend policy, profitability, capital structure, liquidity, and company size on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Second is to determine the effect of dividend policy on the value of manufacturing companies listed on Indonesia Stock Exchange for the 2016 to 2019 period. Third is to determine the effect of profitability on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. 4 is to determine the effect of capital structure on the value of manufacturing companies listed on Indonesia Stock Exchange for the 2016 to 2019 period. 5 is to determine the effect of liquidity on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. And lastly is to determine the effect of company size on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Furthermore, the novelty or difference of this research with previous research, namely in previous research, the sector studied was the goods and consumption industry sector, while the current research, or what I do, is expanded to manufacturing sector. Second, the previous research using the time span under study is 2012 to 2015, while this current research, the time span is under 2016 to 2019. And then for the previous research, the proxy used to measure firm value is price to book value. And then for current research, the proxy used to measure firm value is price to book value and Tobin skew. Next is literature review. First of all is theoretical background. So the theory that I use for this dependent variable is signaling theory. So Zamzani et al. In their research state that signaling theory is an action taken by the company to provide guidance to investors on how management views the company's prospects. Signaling theory, according to Wardani and Subowo on 2020, discussed companies that are required to be able to disseminate information to external parties so that they can affect the value of the company, which is reflected in changes in the company's stock price, because the market will respond to the information as a signal. According to Bayu Ganar, the company's intention to provide information is caused by information asymmetry between the company and the outsiders. Lack of information for external parties about the company caused them to stay away by giving a low assessment of the company, and this can reduce the company's image. Next is company value. Company value is an indicator of how to view the company. High company value gives an indication of good company performance. For creditors, the value of the company is related to the company's liquidity, namely whether the company is considered able or not to repay loans given by creditors. If the company's liquidity is not good, then investors will judge the company to have a low value. The value of the company will provide an overview of the performance and conditions of the company in the past, present, and its prospects in the future. An investor must be able to utilize all the information from financial reports to conduct market analysis and invest in the hope of making a profit. For investors, the value of the company indicates the high level of welfare of the company's shareholders. For the measuring instruments used in the study are price to book value and Tobin-Skew ratio. Next is the first independent ratio. The independent variables is dividend policy. According to Kurniawan and Putra, dividend policy is the decision to determine whether the profits earned by the company will be distributed to investors as dividends or will be retained in the form of retained earnings to finance future investments. The measuring instrument used in this research is the dividend payout ratio. Through the DPR, investors can find out how high the portion of profits given to them by the company. Investors can also find out how much of the profit portion is used as a company operational funds. Next is profitability. Taurin et al. Stated that profitability or profit is a benchmark that has an influence in determining the value of the company in the eyes of shareholders or investors. According to Mary et al., this profitability ratio will provide an overview of the level of effectiveness of company management. The higher the profitability means the better, because the prosperity of the owner of the company increases with higher profitability. The profitability measurement tool used in the study is return on asset. Return on asset describes how much the management or use of a company's assets to generate profits, by looking at how much net profit after tax is generated. Furthermore, the management can choose whether the profits will be distributed as dividends or not. Next is capital structure. The capital structure is the balance of the company's long-term funding, which is illustrated by the comparison of long-term debt to its own capital. The company will try to achieve an optimal level of capital structure with the lowest risk to maximize the value of the company. The proxy used by the author or me in this study is debt to equity ratio. According to Afifa and Susanti's research, the reason for using debt to equity ratio is because by looking at the debt of equity ratio, management can have an idea that if their value is small, the obligations that the company will pay to outsiders or creditors are also smaller. Debt that is greater than equity indicates the company's potential inability to settle its current and future debts. And then liquidity. According to Farah, liquidity is the company's ability to meet all of its maturing obligations. This capability can be done if the current assets are greater than current liabilities. The level of liquidity ratio will affect the interest of investors to invest in a company. The higher the liquidity ratio, the more efficient the utilizations of the company's current assets. The proxy used by the author to measure liquidity is the current ratio. This ratio, according to research conducted by Purba, is a ratio that is quite ideal to be used to find out how far the company's current assets are used to pay off its current debts or liabilities. The last variable is company size. According to Iswajuni et al., company size is a measure or amount of equity owned by the company. According to Denziana and Monica, companies with large total assets will make it easier for management to use the change assets. The larger the size of scale of the company, the easier it will be for the company to be trusted by creditors in obtaining large sources of funds, both internal and external. These sources of funds can be used by companies to further increase companies' profits through expansion and efficiency. The proxy used to measure company size is size, which can be obtained by ln total assets. And then we are going to the relevant research. Based on a research from Delhi in 2017 using multiple linear regression method, profitability have a positive effect. Profitability, or ROA, has a positive significant effect on the company value, as well as liquidity and capital structure. And then research from Sondang in 2019 using multiple linear regression shows that dividend policy has a negative significant effect. Profitability is not significant. Liquidity and size, company size, is positive significant. And then next, the research from Dewi and Astika in 2019 using data panel regression shows that dividend policy, profitability, and capital structure has a positive significant effect on firm value. And then a research by Cynthiana and Artini in 2018 using multiple linear regression shows that dividend policy and profitability has a positive significant effect on firm value, while capital structure and size is not significant. And then a research by Abidin et al. In 2014 using multiple linear regression shows that dividend policy is negative significant to firm value, and capital structure gives a positive and significant effect on firm value, and then company size is not significant. And then the research from Pramana and Mustanda on 2016 using data panel regression shows that profitability and size have positive significant effect on firm value. Next is Utomo and Christie's research on 2017 using multiple linear regression shows that profitability has a positive significant effect, while capital structure and size have a negative significant effect on firm value. Next is Mediawati and Mildawati's research on 2016 using multiple linear regression shows that dividend policy and size have no significant effect on firm value, while profitability and capital structure gives a positive and significant effect on firm value. Next is a research by Dewi and Akajaya on 2020 using multiple linear regression shows that profitability and size give a positive significant effect, while liquidity has a negative significant effect on firm value. And then research from Adiputra and Hermawan on 2020 using multiple linear regression shows that dividend policy has a negative significant effect on firm value as well as liquidity, while company size is not significant. And then a study by Irawan and Kusuma on 2019 using multiple linear regression shows that capital structure is not significant to firm value, while size is negative significant on firm value. And then a research by Mavinia on 2019 using ordinary least square shows that profitability has a negative significant effect, while capital structure and liquidity is not significant. And then a study by Fatima et al. On 2020 using multiple linear regression shows that profitability is positive significant, while liquidity and size is not significant. And then lastly, a study by Yanti and Damayanti on 2019 using multiple linear regression shows that profitability, capital structure, liquidity, and company size have a positive and significant effect on firm value. Next is framework. The effect, first of all, is the effect of dividend policy on firm value. Previous research from Dewi and Astika in 2019, Cynthiana and Artini on 2018, Putra and Lestari on 2016, Wati et al. At 2018, Irawan et al. In 2019, and Putri and Rahmawati at 2017 shows that dividend policy has a significant positive effect on firm value. The dividend policy determines how much profits the shareholders will get. The profits that will be obtained by these shareholders will determine the welfare of the shareholders, which is the main goal of the company. The greater the dividends distributed to shareholders, the higher the value of the company. And then second is the effect of profitability on firm value. Previous research from Delhi in 2017, Dewi Anastika in 2019, Cynthia Nanartini in 2018, Ramana and Mustanda in 2016, Mediawati and Mildawati in 2016, and also Yanti and Damayanti in 2019, shows that profitability has a significant positive effect on firm value. Profitable companies with low risk will facilitate the acquisition of funds from outside parties, thus showing good company value. The greater the return on assets, the greater the level of profit, the better the company's position in terms of assets use, and the better of the value of the company. Next is the effect of capital structure on firm value. Previous research has shown that capital structure has a significant positive effect on firm value, which is a research that be done by Delhi in 2017, Dewi Nastika in 2019, Abidin et al. In 2014, Mediawati and Wildawati in 2016, Yanti and Damayanti in 2019, and also Rabianto et al. At 2020. Effective capital structure decisions can lower the cost of capital issued by the company. Debt can be used to control the excessive use of free cash flow by the management, thereby avoiding wasted investment, which will increase the value of the company. And then the effect of liquidity on firm value. Previous research by Delhi in 2017, Sondang in 2019, Yanti and Damayanti in 2019, Putra and Lestari in 2016, Amijaya et al. In 2019, and also Rahmasari et al. In 2019 shows that liquidity has a significant positive effect on firm value. A high level of liquidity indicates that the company is in good condition. The higher the liquidity ratio, the higher the company's ability to fulfill its obligations. Companies that have more liquid assets are generally in form of cash, have a high dividend payout ratio, and can increase the value of the company. Lastly is the effect of company size on firm value. Previous research by Sondang in 2019, Pramana and Mustanda in 2016, Dewi and Nakajaya in 2020, Yanti and Damayanti in 2019, Putra and Lestari in 2016, and also Amijaya et al. In 2016 shows that company size has a significant positive effect on firm value. A large company size shows that the company has the ability to increase sales so that investors will respond positively and the value of the company will increase. In addition, the larger the size of the company, then there's a tendency for more investors to pay attention to the company. This is because large companies tend to have more stable financial conditions. Next, we enter the research model. Can be seen on the left is the variable X, or what we call the independent variable. The independent variables that use are dividend policy as a hypothesis for hypothesis 1, then profitability for hypothesis 2, capital structure for hypothesis 3, liquidity for hypothesis 4, and company size for hypothesis 5, which directly affect firm value. And then next one is hypothesis. So therefore, there are 6 hypotheses in this research. The first one is dividend policy, profitability, capital structure, liquidity, and company size has a significant positive effect on firm value, on the value of manufacturing companies listed on the Indonesia Stock Exchange in the 2016 to 2019 period. And then hypothesis 2, dividend policy has a significant positive effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. And then for hypothesis 3, profitability has a significant positive effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Hypothesis 4, capital structure has a significant positive effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Hypothesis 5, liquidity has a significant positive effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Hypothesis 6, company size has a significant positive effect on the value of manufacturing companies listed on the Indonesia Stock Exchange for the 2016 to 2019 period. Next, we are going to chapter 3, or research methods. So for the time and place of research, this research was conducted on manufacturing sector companies listed on the Indonesia Stock Exchange, or IDX, for the period 2016 to 2019. The data used in the study is secondary data obtained from the annual report of manufacturing sector companies available on the official website of each company and the official website of the Indonesia Stock Exchange. And then the research approach used in this research is a quantitative approach, research that emphasizes testing theories through measuring research variables in a numerical scale for numbers. The research method used is causality research, which is proof the cause and effect relationship of several variables. Next is research variables. The first is company value. The indicator used in the study is price to book value, which is obtained by dividing the market price per share and book value per share. And also I use Dobbin's Q in here, which can be obtained by dividing market value plus debt with total asset. Next is for dividend policy. It can be obtained by dividing dividend per share and earning per share. For profitability, we can obtain using dividing net income and total assets. And then for capital structure, can be obtained by using debt to equity ratio, which is dividing total debt and total equity. Next is liquidity. We use current ratio here, which can be obtained by dividing current assets and current liabilities. And for company size, using size, which can be obtained by learn total asset. Next is population and sample. First is manufacturing companies listed on the Indonesia Stock Exchange, or IDX, for the 2016 to 2019 period, totaling 184 companies. Second is manufacturing companies that did not issue financial report as of December 31st for 4 consecutive years in the 2016 to 2019. And then third one is manufacturing companies that have negative equity in the period. And then lastly is manufacturing companies that do not provide company data, complete data and information regarding research variables in the annual report, which is 0. The total samples that I use is 129, and with the total of observation of 516. Next is data analysis technique. First is descriptive statistic. It's a type of information presented in a few words to describe the basic features of data in research, such as the mean, standard deviation, maximum and minimum. And then second is panel data regression model analysis. Panel data regression is a combination of cross-section data and time series data, where the same cross-section unit is measured at different times. So in other words, panel data is a data from the same individuals who are observed over a certain period of time. And then the next one is panel data regression testing using Chow test and Hausman test. Chow test, the purpose of the Chow test is to find out which method is the best between fixed effect and common effect. In this Chow test, a decision is made if the p-value is less than 1.05, then hypothesis null is rejected, so that the approach model used is fixed effect. Meanwhile, if the p-value is more than 0.05, then hypothesis null is accepted and the right approach model is the common effect. Next is Hausman test. Hausman test is defined as a statistical test to determine whether the fixed effect model or the random effect model is the most appropriate to use. If the results of the Hausman test show a probability value of 0.05, The most appropriate final data regression model is the fixed effect model. Meanwhile, if the Hausman test results show a probability value more than 0.05, then the most appropriate final data regression model to use is the random effect model. Lastly is a classic assumption test. The purpose of classic assumption testing is to provide certainty that the regression equation obtained has accuracy in estimation, is unbiased and consistent. The classical assumption test used is as follows. The first one is normality test. The normality test aims to test whether the independent variable, the dependent variable, or the two variables have a normal distribution in the regression model. And then multicollinearity test. This test is to determine whether the regression model finds that there is a correlation between the independent variables. A good regression model should not have a correlation between independent variables. And then third one is hypothesis test or t-test. It aims to determine whether the independent variable partially or simultaneously can affect the dependent variable. If the significant value is 0.1, then the hypothesis is accepted. This means that partially independent variables has no significant effect on the dependent variable. And then lastly is coefficient of determination. The sense of the coefficient of determination is to measure the extent to which the model is able to explain the variation of the dependent variable. The value of the coefficient of determination range between 0 or null and 1. A low value means that the ability of the independent variables to explain the variation of the dependent variable is very limited. A value close to 1 means that the independent variables provide almost all the information needed to predict the variation of dependent variable. So this is the end of my presentation. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.